This is the part of the show where we talk about financial planning. For that, we bring in our financial planning expert, Harrison Johnson, the CFP. Harrison, how you doing?
Doing well, doing well.
Well, we're talking about, again, taxes because it's that time of year. Beware the tax height above $505,000. I've not heard of the $505,000. What is this we're talking about?
So this year, 2026, it's $505,000. Last year, it's $500,000. This has to do with the ability to write off state income and property taxes, the SALT deduction. I've mentioned this before, but I wanted to get into the details of really what this means. So if your income is under that threshold, then in 2026, you can claim SALT deductions as an itemized deduction up to $40,400. As your income exceeds that $505,000 limit, that $40,000-ish deduction gradually declines to $10,000. So it's a lost, you could say, $30,400 deduction as your income goes from $505,000 up to about $606,000. So when you're in that tax bracket as a joint filer, that's where you're in the 32% tax bracket. But on that extra $100,000 of income, because of the phase out of that SALT deduction, your taxable income really increases by a little over $130,000 on only $100,000 of income. So since you're in that 32% tax bracket, the real marginal impact of the loss of that deduction means that your tax rate's really like 42%. The other thing that's interesting about that is when you're at that income level, as you get up to that level, you just barely start to go above the 24% bracket. You just barely make it into the 32% bracket. And then because of that loss reduction, it's really like 42. So what's happening is you go from like a 24% marginal rate really quickly to like a 42% marginal rate because of that reduction as your income exceeds $505,000.
There's a lot to that, but I think people are hearing the $505,000. Is there things they can do to prevent their adjusted gross income going above $505,000? Anything they can do is like, oh, I got to get down to 505.
So this is something that you need to be conscious of throughout the year. Things that are adjusted gross income's all of your income. So anything that you would draw from a retirement account, interest, dividends, capital gains, business income, rental income, annuity income, Social Security income, wages, all of that stuff is included on your adjusted gross income. So it's important to have an understanding of about what those amounts are, but also throughout the year, you need to be aware of, how much you're withdrawing from certain accounts, what types of things you're selling throughout the year, because all of that has an influence on what that adjusted gross income is.
Yeah, and I know this doesn't impact a ton of people, but it does serve a broader purpose, I would say, in terms of making sure you're aware of, I guess, those different brackets, right? You talk mainly about, the 10, 12, 22, 24, 32. So, I mean, the difference between 12 and then the 22 and then the difference between the 24 and 32 are huge jumps. And, I'm not saying you should always make decisions around that if it's still the right financial decision, but sometimes people, they'll take a distribution at the end of the year and not realize all of a sudden, boom, that could spike them, in this case, above $505,000 and create issues. So, I mean, understanding, I guess, the ramifications of these different taxable levels is just so important.
And this has to do with ordinary income. So one area that this could really trip people up on is if they're doing Roth conversions or something like that. If that's done well, it can be a good thing. But the whole idea behind a Roth conversion, for example, is you're converting money at a lower marginal tax rate than you would otherwise be in. However, if you're at that $505,000 limit and a conversion pushes you over that, right now the maximum federal marginal tax rate is 37%, but the cost of doing a conversion if your income is above that is really 42% because of the reduction of the SALT tax. So almost nobody would benefit from this unless they were doing like a massive conversion of several hundreds of thousands of dollars, which almost no one would need to do because they don't have that. Normally, people don't have that much money in their pre-tax accounts. So again, it's, we can look at the tax brackets and we can say, the SALT deduction, $40,000 scaled down to $10,000. Really, what does that mean, though? How does that align in the tax brackets, and what is the tax influence of every additional dollar of income that you have?
And this is why people need a fee-based financial planner, because these are things you look at And people say, yeah, I'm going to do a Roth conversion. They don't think about all these other things that go on. And the other thing I want you to comment on quickly as well, we were talking about before during the break here, was people say, oh, it's not true. The billionaires and millionaires, they got all these tax deductions. Kind of explain a little bit, as we talked during the break, that it's real. Yes, they get them, but there's reasons for it and stuff.
People with high levels of income pay a lot of taxes. Now, it's a completely different argument to get into, what billionaires do and don't do on the taxes that they pay and things like that, because a billionaire may or may not be a high income earner, depending on where they are deriving cash from. So I think the point is, if you are somebody who has a high level of income because you're very skilled in your field, maybe you're a doctor and you have a high level of income, maybe you're an athlete and have a high level of income, maybe you're an attorney, maybe you're an engineer, maybe you work in tech, maybe you have a lot of rental properties, so there's income coming in, maybe you have a lot of retirement assets, so there's a lot of income coming in. People who make $200,000, $300,000, $400,000, $500,000, $1 million a year, you're paying a lot of taxes. And that can be compounded if you don't understand how the tax situation works and how different income sources and assets should be structured, because you get hit on things like this. This that I'm talking about, again, a 42% essentially tax rate, that's in addition to state taxes. So in that bracket, this potential person would be in the 9.3% bracket in California. So that means their real tax rate is over 50% in those income levels. So people with high levels of income pay a lot of taxes, and that's just kind of how that goes.
I think people, they get so fixated on the one-offs, right? Like Larry Ellison, for example, he's got billions of dollars in Oracle stock and
hundreds of billions.
Oh yeah,
yeah.
He doesn't really have much income, but what he does is supposedly he borrows against that stock and he takes on debt. Now you ask the average person, hey, you have this money, would you be willing to borrow against it? Most people would not, and I don't know if I would either, especially on an asset like Oracle that last year I think went up 50% just to fall 50%, and you're borrowing against that. It's a crazy approach in my mind, but that is how people like that don't pay any taxes because they're living off that asset. But I will tell you, he had paid a lot of taxes to accumulate those assets over time. But again, people will fixate on that one-off, but the broad picture is, wealthy people do pay taxes.
Yeah, and there's only like 1,000 billionaires in the United States, so there's really not that many of them. And again, that's a whole separate thing. And at the end of the day, there's people out there that are just luckier than you and me and us. So there's not a lot that you can do about that. But what you can do is take a good look at your own situation and make sure that you keep your own tax liability as low as you possibly can. So that's what it comes out to, because there's a lot more people that make $500,000 than there are who are billionaires out there.
And a lot of people, they have to borrow the money to get those big tax deductions. It'll work for like a year or two. And it is funny because sometimes we tell people, well, you're better off borrowing against your home for a line of credit or against the S block. And they say, oh, no.
That's an extremely good point going down that, because, everyday people can do that. You can pull out a HELOC. You can borrow against investment accounts. You can borrow against different types of assets, but people don't like to borrow. Well, that's what extremely wealthy people do. They borrow and they use that to create liquidity. So what that means is all their money is invested all the time. They don't have a checking account with $100 billion in it. It's all invested. So most people that you talk to are willing to invest all their money all the time. Again, focus on what you can do, because there's other situations that really don't apply to us normal people. There's nothing we can do about it anyway.
Yeah, leverage is a tool. If you know how to use it, you can do very well. But people they shut down and they're like, no, I don't want to have any debt. Like, that is wrong.
Mortgage interest is deductible. There you go. There's a tax benefit for everyday people.
All right. Well, Harrison, thank you very much. We appreciate it. Have a good day. Again, if you want to contact Harrison, you want a free consultation with him, give him a call at the office, 858-224-0004. Again, that's 858-224-0004. Or contact them through the website, smartinvesting2000.com. Again, that's smartinvesting2000.com. Send them an email, set up a time, again, for that free consultation. I think you'll learn a lot and maybe save a lot in taxes and do better on the investing side as well.
Mm-hmm.
So